Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending January 19, 2024. Let's start with a look at this week's markets at the close on a Thursday. Lots of red on the screen here. We mentioned that in the last few reviews. The momentum at the end of 2023 was very strong, and the setup for 2024 was, let's say, a little bit shaky in the sense that we had very strong returns for both bonds and equities to end the year. We ended the year with valuations that looked pricey. So we did think that this could lead to some volatility in the first half of the year, as maybe the expectations are revised. And also, since all of those expectations, or at least most of those expectations, were linked to the views on what central banks, most importantly the Fed, but still the Bank of Canada, an important player here, what they would do in 2024 in terms of cuts, well, depending on the macro data and depending on the mood of the markets, well, the ground could be a bit shaky. So volatility in H1, and this is what we have so far. Interest rates, negative volatility here, I would say. So moving to the downside, this is of course linked to the inflation data that came out this week. Rebound, which was expected from economists, from 3.1 to 3.4. That's right on consensus, the data that we had, but still it doesn't play into the hands of the scenario that was fueling the markets in the second half of 2023, that rate cuts were imminent, just around the corner, and that we would get a lot of rate cuts in 2024. So thus, negative returns on the year. We're at minus 3%, minus 2.6% rather for the Universe Index, close to minus 6% so far for long bonds. We still think that we should have positive returns on the year, but we did expect a volatile start to the year. So there it is. For the TSX, negative on the week. The S&P 500 a little bit versus, and the Nasdaq, bit of a mixed bag. Year to date, we're negative territory in Canada. Still positive in the US, but barely. Emerging markets, mostly because of the drawdown that we're seeing still on the Chinese stock market. Emerging markets are having a rough start to the year here. Price of oil higher, Canada CAD, euro, and gold a little bit lower to start the year. So lots of volatility already. Canadian inflation now rebounding in December, closing the year at 3.4%. The fight against inflation is not done yet. We see that there are some data that is showing the stickiness of inflation, and it would be prudent to expect that inflation will be a theme that will still be around for most, if not all, of the year. And the job of the Bank of Canada, the central bankers, is not an easy one to make sense of everything that's going on here on the inflation front. We know in Canada that we still have wage growth pressures that are important. We're above 5% growth on wages year over year, which is at the top end of the range that was mentioned by Governor McLean about a year ago. He said that if wages continue to grow by 4 to 5%, this would not be consistent with inflation getting back to 2%. So we're still there. When we look at the components here, well, year over year, the number was pushed up a little bit because of the base effects. So December of 2022 was a very soft month for inflation, and it kind of moved out of the sample. So the comparison here was not favorable to inflation getting back down to 2%. But when you look at the latest monthly figures, we see that inflation remains strong recently over the last few months in food, and both food at home and in restaurants, in rents, in the cost of servicing your mortgage. So there's more and more Canadians resetting their mortgages at higher rates, and also transportation costs, so new cars, air travel. So important elements that have a decent strong weight in the CPI formula are still seeing inflationary pressures. So what to do? Well, if you look here at the next slide, so there's two things here on the left. You have the latest forecast from the Bank of Canada. This is from the Monetary Policy Report of October 2023. And I show it here because there's a new one that's going to be published next week, January 24th. There's a decision by the Bank of Canada. We don't expect them to do anything. We expect them to revise this forecast here and look at the forecast in the red box. 2.5% inflation expected in 2024, 2.1 in 2025, but the numbers in parentheses below were the previous forecast. So you see that it was revised higher, and there's another forecast coming out next week. So expect market participants, and I will be discussing that for sure with you, to put lots of focus here. How did the view from the Bank of Canada on inflation over the next 2 years evolve? Did they upgrade it, downgrade it? That's going to be a very important factor. We also expect them to start to set the table for future rate cuts in 2024, change the language. You know, in the latest statements, they were still saying that they were ready to hike if needed. But after the last decision, Governor Metlem gave some interviews where he said that they were expecting the start of the year to be rather tough on the economic side, but rate cuts are likely in 2024. So you need to start to set the table for that. So the language will be very important. So we'll be focusing there. On the right, just to show that the evolution of the consensus for inflation in 2024. So this is the Bloomberg consensus survey. The lines move because the surveyed economists, they can just at any time go and reset their forecast here, so you have an idea of how the mood swings. And the red line, of course, is Canada, and the inflation expectations went from about 2% in the middle of last year to 2.5% at the end of the year when looking forward to 2024. So still a moving target. Inflation is not going away yet. Finally, here the Bank of Canada's Business Outlook survey came out last week. Two very important conclusions here. On the left, you have the balance of opinion for the whole survey, the composite. So we were still in negative territory, a little bit of an uptick, but this is a summary of the survey. It shows that business expectations for economic activity over the short and medium term remains subdued or depressed. So slow economy ahead, this is what businesses say. But on the right, their expectations for inflation on average over the next 2 years. Here's the percentage of participants that expect inflation to remain above 3% over the next 2 years, and it's still the majority, and it ticked up in the last survey. So subdued economic activity, sticky inflation, that's kind of smells like still some kind of stagflationary environment. So not an easy environment for the Bank of Canada. Next week we'll be listening to them, and we'll be discussing that here for sure. So what to watch next week? We'll have in Canada the Bloomberg Nanos Confidence Index, the Bank of Canada rate decision, and the CFIB Business Barometer. In the US, we'll have the S&P Global Manufacturing PMI, should be going sideways, still in contraction territory below 50. Q4 GDP growth for 2023 should be a bit slower than Q3, but still in positive territory at 1.9%. Durable goods orders slowing down, but still positive. And PCE deflator, so the favored price index from the Fed, a little bit an acceleration month over month, 0.2%, year over year, 2.6%. So there's going to be lots to discuss next week. So that's it for the week. So if you want to reach us, ia.ca/economy, well, you'll find this review on the podcast. If you want to dig more deeply into our thinking on the strategy, and you want to have more, let's say, sophisticated takes on everything that's going on, macro and strategy monthly on the iagam.ca/insights webpage. You'll find it there. So thanks for following us on a weekly basis, and I'll be back again next week.